Open enrollment just dropped two plans in front of you, and one of them looks obviously safer. Lower deductible, predictable copays, the plan your parents probably had. The other one has a scary word in the name, high deductible. Most people click the safe looking option without running a single number, and for a healthy chunk of them, that's the most expensive click they'll make all year. A little over $1,000. That's roughly what a health individual can leave on the table in a single year by picking a PPO over a HSA eligible plan once you account for the premium difference and the tax-free contribution room that never gets used. Not because the PPO is a bad plan, because nobody ran the comparison past the deductible number. In this video, we'll cover what each plan actually does, the tax advantage that makes this decision lopsided for some people, who should pick which, and the case against everything I'm about to tell you. A PPO is the plan you're used to: higher monthly premium, lower deductible, copays for doctor visits, and prescriptions that kick in almost immediately, and a broad network of providers, predictable costs, higher price of admission. An HSA is not itself a health plan. It's a tax-advantaged savings account you're only allowed to open if you're enrolled in an HSA-eligible high-deductible health plan, or hdhp. For 2026, that means the plan's deductible has to be at least $1,700 for self-only coverage, or $3,400 for family coverage, and the plan's total out-of-pocket maximum can't exceed $8,500 self-only or $17,000 family. In exchange for that high deductible, you typically pay a noticeably lower monthly premium, and you unlock the ability to contribute to the HSA itself. Now, here's what separates an HSA from literally every other account in the tax code, including your 401k and your Roth IRA. It's the only account that's triple tax advantaged. Money goes in pre-tax, it goes tax-free while invested, and it comes out tax-free too, as long as you're spending it on qualified medical expenses. A traditional 401k only gets you two of those three. A Roth IRA only gets you two of those three as well, in the opposite order. The HSA gets all three. For 2026, you can contribute up to $4,400 for self-only coverage or $8,750 for family coverage, plus an extra $1,000 catch-up if you are 55 or older. That money rolls over every year. Unlike a flexible spending account, there's no use it or lose it deadline. If you don't spend it, it keeps compounding, and most HSA providers let you invest the balance once it clears a small cash cushion, the same way you'd invest a 401k. And here's the part almost nobody mentions. After age 65, you can withdraw HSA money for anything, not just medical expenses, and you'll only owe ordinary income tax, exactly like a traditional IRA. Before 65, non-medical withdrawals cost you a 20% penalty on top of the income tax. That's steep, but the account still behaves like a bonus retirement account if you never need to touch it for healthcare. So a few other terms show up in this decision, and it's worth knowing where they fit. An HMO trades network flexibility for a lower premium than a PPO, usually requiring a primary care referral to see a specialist. It's a different trade-off entirely, network restriction instead of deductible size, and it's not a direct substitute for either plan discussed here. A limited purpose FSA can actually be paired with an HSA. It only covers dental and vision, but it lets you use pre-tax dollars for those specific costs without touching your HSA balance, effectively stretching your total tax advantage healthcare spending. A general purpose FSA, the kind paired with a PPO, is worth understanding on its own terms. It's pre-tax and reduces your taxable income the same year, but the money doesn't roll over the way an HSA does, and you lose it if you don't spend it. That's a real design difference, not a lesser version of an HSA. It fits a PPO because a PPO plan doesn't qualify you for an HSA at all. So here's the actual decision tree. If you're generally healthy, have at least a few $1,000s in savings to cover the deductible gap if something happens, and you can genuinely afford to leave HSA contributions invested instead of spending them on routine care, the HSA eligible plan usually wins. Lower premium, the triple tax advantage, and a growing account that becomes a second retirement fund if you stay healthy. if you have a chronic condition, take regular expensive medications, or expect to hit your deductible most years anyway, run the actual numbers before assuming the PPO is safer. Sometimes it still wins. Sometimes the HDHP's lower premium plus the tax savings on your contribution still comes out ahead even with predictable high usage because you're saving on every single paycheck, not just in a bad year. If you don't have savings to absorb a surprise few $1,000 bill before your deductible is met, the PPO's predictability is a legitimate answer, not just a safer feeling. Insurance exists to protect you from a bill you can't handle, and an HDHP without a cash cushion behind it isn't actually protecting you. Now, I want to say something that might surprise you coming from a video that just spent over 4 minutes making the case for an HSA-eligible plan. The tax math only works if you actually have the cash to front the high deductible when something happens. If a broken arm, a surgery, or a bad diagnosis hits you before you've built up savings or an HSA balance, you can be staring at thousands of dollars due at once, and no tax advantage or paper helps you if you don't have the cash today. People in the FIRE and personal finance communities who push hard on HDHP plus HSA are disproportionately high earners with large emergency funds already in place. Their math doesn't automatically transfer to someone living paycheck to paycheck. There's also a real behavioral trap. An HSA only becomes a triple tax advantage retirement account if you actually invest it instead of treating it like a checking account for medical bills. Most HSA holders never invest a dollar of it. If you're going to spend the balance down to zero every single year on routine care, you're not getting the retirement account benefits at all. You're just the tax deduction on contributions, which is real but much smaller than the full pitch implies. Now, here are the 3 mistakes that cost more than the plan choice. Mistake 1, picking the HDHP for the tax advantage and then never contributing to the HSA at all. The plan alone doesn't save you money, the account has to actually get funded to unlock any of what we covered. Mistake 2, leaving HSA contributions sitting in cash indefinitely, instead of investing them once you've built a reasonable buffer, usually enough to cover your deductible plus a bit of cushion. Cash in an HSA earns close to nothing. Invested over decades, it behaves like an extra IRA that also happens to cover medical costs tax-free. Mistake 3, and the most expensive one, not comparing the actual total annual cost between the plans at all and just defaulting to whichever one sounds safer or matches what you had last year. 12 months of premium difference plus your realistic expected medical spending is a 5-minute calculation most people never run, and it's the entire ballgame. So here's the verdict. For most healthy people, with even a modest cash cushion, the HSA eligible plan, in my opinion, wins on pure math. Lower premium, a tax advantage no other account offers, and a balance that can quietly become a second or even third retirement account. If you don't have savings to absorb a surprise deductible, or you know you'll hit expensive care most years without the numbers actually favoring the HDHP, the PPO's predictability is the right call, and there's no shame in choosing certainty over a theoretical tax edge you can't currently afford to bet on. But the most expensive mistake in this entire video isn't picking the PPO or picking the HSA eligible plan, it's picking either one without running your own numbers first. This is a summary of what the research shows, not personalized financial or tax advice. Your specific plan details deductible and health situation changes this math. Talk to your benefits administrator or a CFP for your specific situation. This content is for general educational purposes only. It's not personalized financial, tax, or insurance advice. Plan details, contribution limits, and eligibility rules can change, so verify your specific plan's numbers during open enrollment. If you enjoyed this video, let us know and comment below. Are you on a HSA eligible plan or a PPO, and did you actually run the numbers before choosing? Thanks for watching this video. We'll see you in the next one.